Hi, I'm Christoph Gleisch, the President and CIO of Harbour Capital. We're here today to talk about active versus passive investing. I'm delighted to be joined by Ross Frankenfield, our Head of Investment Specialist team.
Thanks, Christoph. It's great to be here.
So Ross, we seem to be living in this polarized world in many ways, but as it pertains to investing, it feels like there's really now just two camps of investing. You're either passive or you're active. What do you think of that?
Well, I would say first and foremost at Harbour, we are fervent believers in truly active management. And I think a lot of the debate around this binary active versus passive dynamic is a little bit misguided because the vast majority of index products today, we would assume are not truly passive. In many ways, there's a lot that can change underneath the hood of those products. And those products can be susceptible to a lot of growing risks like concentration and or diversification risk. So we would really think about asset management much more along a spectrum where on one side you have truly active management, and those are the types of strategies that we've historically gravitated towards. And on the other side you have less active management, which comprises a lot of the index products out there today.
So it's a little bit more on a spectrum and a little bit more nuanced and less binary. So let's shift gears. What about the conventional wisdom that active only works in certain spots of the market, the more esoteric, less efficient spots? Emerging markets is always a good one that kind of comes up. But I think sort of most simply put, people think that nearer you are to US large cap liquid equities, the more you should be passive, and the further you get away from that, you should look at active. What are your views on that?
Yeah, I mean, we certainly hear that conventional wisdom. You can hear it in terms of what's emanating from the media. You can see it from investor flow patterns where there's a lot of money going passively or to index strategies within areas like US large cap. But we think that a lot of that narrative is really being driven by recency bias, where if you look at the last decade, areas like US large cap or US large cap growth have just been very hard for active managers to outperform the benchmark. And that's created this view that through that recency bias, that's likely to persist into the future. But when we look at the long history of active versus index strategies, we don't see a protracted rise in dominance of index strategies. We see a clear oscillating pattern of leadership going back and forth between active as well as index managers. And I think that's what's driving some of this conventional wisdom.
That's interesting. Can you think of any recent examples in maybe one of these more efficient asset classes where actually active's done well?
Yeah, I mean, 2020 is a great example. You had an environment where there was unparalleled economic discord and uncertainty among investors. And yet, if you looked at those so-called efficient asset classes like US large blend or US large growth, what you found was the top quartile active managers significantly outperformed their benchmarks in that environment of uncertainty. Another thing that we've observed historically is that if you go back to periods where the indexes like the S&P 500 or the Russell 1000 growth historically had levels of index concentration that were similar to levels that we had today, that subsequently created a very fertile environment for active managers to perform quite well. So we think that that's a possibility for active management, again, within some of these so-called highly efficient asset classes to shine going forward.
So generally these periods of concentration in the indices are typically followed by a better environment for active managers where they're able to find opportunities through idiosyncratic stock selection.
Exactly. And again, getting back to that notion of recency bias, if you look at the last decade, the vast majority of active managers have underperformed a benchmark like the Russell 1000 growth. But if you go back to the early 2000s, there was a multi-year period where the Russell 1000 growth regularly ranked below average relative to the majority of active peers. And I think a lot of that was significantly driven by active managers not being tethered to that concentration risk potentially unwinding.
And as the old adage goes, whilst history may not repeat itself, it often rhymes.